Good morning, ladies and gentlemen. This week we start with our favorite spread for risk on, risk off, SPY TLT. It is in an uptrend since 2009, and what we are looking for is we're looking for signs of reversal to confirm that we are about to turn the risk profile that we've been having for the past almost decade. Last week, the spread reversed very powerfully with a rally in SPY and also with the dump in TLT on Friday, back to risk on. This is the 50-day moving average, this is the 200-day moving average. They are coming in together. They will very soon be on top of each other in the next couple of weeks, and we still have this line of support which goes all the way back to 2009. So we can see that here we are exceedingly unstable. This is a very unstable market which is about to make a big move one way or another. It is almost impossible for the market to make the big move higher in terms of SPY because the valuations are now so stretched that we, in that case, would be talking about valuations of, I don't know, over 20 times future earnings, which we find incredible that can be sustained, but we are willing to be surprised. But this is what we are looking for. We are looking for a cross between this 50-day and this 200-day, which at some stage has to happen if the risk off stage of the market is to happen in the next few weeks. The first risk off indicator, which is credit, the one that normally goes first, has made the crucial turn. What has not happened is that the 200-day moving average has not moved down as yet. It is still moving up while the 50-day has crossed it, giving some sort of a sell signal. What we have here is more indecision, more need to trade this area before both of these moving averages can move down. It is still a waiting game, a game of wait and decide. It is unlikely that it's going to be resolved in the next week. It is a topping is a long-term process. It takes time to turn these moving averages, and that is what we're witnessing. But the first warning sign, which is credit, that has already happened, and we can tick it off our list. Similarly, XLP, XLY has come back down to test from above the trend line that it's been in, the channel that it's been in for the past year. It is again highly unstable at these levels. It'll either go and make new lows, which would naturally be very bullish for stocks, or it will continue to turn these moving averages. This is again a process. We would not be surprised by erratic price action here ahead of a turn. But again, this says that unless it closes at least 2 weeks above the 200-day moving average, we are not going to have a decisive move in XLP, XLY in the foreseeable future. This is very odd behavior. This is a big battle between the risk on, risk off, a battle which would more likely than not last for a longer time rather than a shorter time. And this huge battle between risk on and risk off is reflected in the yields of treasury bonds. This is the 30-year yield level, and we cannot break and close below the very important 271 level. We tried it last week, we could not close below it. Now we are reversing and will probably test higher around the 282 to 84 area. What we have done is we have turned the 200-day moving average, but we would not be surprised by a protracted period of trading in this kind of area before attempting this very important yield level of 271 again in the next few weeks. So it's a game of churn at these levels before attempting to break what would be a triple bottom and go lower in yield. We are still convinced that at some stage over the course of the next 6 months we will trade around the 2.5% yield, simply because there is no inflation and there is very little likelihood of the Fed continuing to tighten beyond what they will probably do, which is one more rate hike sometime in December. We think after that the Fed is probably done and yields can come down. SPY has done very little wrong. It has done an ABC and now is probably finished the third wave of this small wave. First wave, second wave, third wave, a quick fourth wave on the news about North Korea, back down towards 2440, and then we expect a final and fifth wave to take us up to new highs in the 2500s, 2515, 2530, before we can consider by Elliott wave standards this whole move done. We just cannot see the market going higher than that because the valuations are now so ridiculously stretched in historic terms and in forward terms that we would expect at best a period of 6 months worth of consolidation at those levels if the market is going to stay here. But the dangers then really revert to a very sharp move down to test the 200-day moving average at some stage. It is always helpful to put things into longer term context. This is a monthly chart of SPX, and we can see how far away we are from the major moving averages that always support the market. It is unlikely that we will test this moving average at 1421, but what is perfectly normal is after a 5 wave up, and this being the last bit of the last wave, is that we come and test at least this moving average, which is 2138 at the moment and rising. So a move from up there to 2200 will do absolutely no harm to the longer term picture excuse me of the market. It will still be in an uptrend, but we certainly need to correct these excesses. We have moved from 1800 to 2400 on very little fundamental news for the American economy. It has not accelerated. Yes, there might be tax cuts, but it doesn't really justify this huge move. It will probably be a case of buy the rumor, sell the fact, and then we will have this move back down. If we try to have a look at where the major support is, the major support is here at around 2560 and then finally around 2425. If we start trading below 2460, which I fully expected to this month, then 2425 becomes the big battle level. If we can break 2425, let me try and do this slightly better for you. The big moving average support comes in at 23.50 and finally around 22.50. We fully expect these moving averages to be tested over the course of the next 6 months, simply because a market which is done going up is very vulnerable to the downside, and any market which is vulnerable to the downside eventually comes and tests the moving averages that it broke out from. In terms of the very short term, have a look where the volatility spreads are. 134, this is about as high as it has ever been before it gave a sell signal. The last one was here, and then we had a 30-40 point drop. We expect very much the same thing to happen here, probably on the back of this Korea news, which we don't think is fundamental. It might easily go back to around the 24.40 level before it bounces, and we can see that in the next chart. In this 300-minute chart of ES, we can see just how overbought the market got it going into quarter end, and the markups everybody wanted to achieve for their books. And now that the markups are done, and with the sort of North Korean news, we can probably come all the way back down towards 24.45, and there we can decide where the next move is going to be. We would prefer a final push into the new quarter to take out these highs, get everybody bullish, get everybody long, and then we will be definitely calling for an end to this bull market around 25.15 to 25.30, because the valuation levels would be then so ridiculous and people so euphoric and bullish that we would rather leave the market there, and if it goes further, so be it, but we will be completely in bonds and volatility once it reaches 25.15 to 25.30. Fundamentally, we just cannot see any justification for higher prices than that, and we think that the market will be extremely vulnerable from those levels. Finally, a word about volatility. Volatility is, we think, showing that not everything is all right up here. We have numerous divergences building up. This is XIV, so the opposite of VXX. It might be forming some sort of head and shoulders top here. That would not surprise us in the slightest. We think that when a market gets to such elevated valuations and when everybody is long and looking one way, it is very likely that you get precisely the opposite result. And it would not surprise us that at some stage XIV manages to finally drop out of this channel that it's been in since basically the beginning of the year. And if it did that, we would be looking for much lower levels, and we'd be looking for gap fills in the 40s and 50s. That would take volatility at least up into the 20s. So that is why we think the risk reward, once the market gets up into the 2500s, and if XIV has not made new highs but it's still churning around below new highs, that will be the time to buy short-term volatility for a move much higher. To summarize our conclusions, the 5 and 10 years have probably stopped going down together with the 30-year. We're looking for 275 before down again. The bunds and bobbles, we are now at levels that we think it's more advantageous to sell the contracts rather than buy them. Going into the, we are now 2 weeks away from the ECB first meeting, where they might announce some sort of what they're going to do about the reversing QE. So we think that the upside is very limited in those contracts, and it is better to sell them on rips higher than to buy them on dips. There's still no signs of commodities going up, therefore very little inflation, therefore we think we're still in a trading range in those. Yes, we've told you what we think. We think that the next move is down, but eventually we want a last hurrah up to 25.15, 25.45, where we are prepared to be very short of the States relative to emerging markets and the world. We still like NQ. We think NQ is going to outperform on the upside, but then will also outperform on the downside. The Russell has made a move above the 1383 key close, but we think that that will now, if it makes a lower high when the ES reaches 25.15, 25.45, that will be the leading indicator that something is rotten with ES and NQ, and they will turn down. Volatility, any dip down towards 11 mark is a very good buy. We've turned to buy the dips in volatility rather than sell the rips. And the super cycle we think is very much alive, out of expensive US stocks into cheaper EM and developed market apart from XLK. Therefore, that is why we have still the butterfly long 1 XLK, short 2 SPY, long 1 EM. But this is a very much a longer term trade. There will be big dips in that, and we want to add on the big dips. It is something that is going to last for probably months and weeks, months and quarters. So we want to have plenty of firepower to keep on adding to that position. If you want to put that position on, don't put on more than 20-30% of what you would like eventually to have. It is something that you will have plenty of opportunity to add to as the market develops. Thank you very much indeed, and speak to you on Monday.